Across the United States, massive AI infrastructure projects are expanding at a historic pace. Data centers are being planned, semiconductor investments are accelerating, and companies are racing to build the computing power needed to support the next generation of artificial intelligence. But at the same time, borrowing costs remain elevated, and some analysts are beginning to question whether this rapid expansion is happening at a sustainable pace. The real conversation emerging among economists isn't whether AI will reshape the global economy. Most agree it likely will. The deeper question is whether the financial foundation supporting this transformation is strong enough to handle the scale and speed of current investment. One major factor influencing this discussion is interest rates. With inflation still shaping monetary policy decisions, some analysts believe borrowing costs could remain higher for longer than markets previously expected. Higher rates can help stabilize inflation and strengthen currency confidence. However, they also increase the cost of capital, which technology companies rely on heavily when funding large infrastructure projects. Artificial intelligence development, particularly at the hardware and data center level, requires enormous upfront investment. Many companies are rapidly expanding computing capacity under the assumption that future demand will eventually justify today's spending. This strategy prioritizes building infrastructure ahead of widespread commercial adoption. This approach contrasts with investment strategies sometimes seen in other regions, where companies gradually expand production after demand has already proven itself. If borrowing costs remain elevated, companies may face increasingly complex decisions about how aggressively they continue expanding AI infrastructure. Several major technology firms have discussed ambitious plans involving tens of billions of dollars in potential investment into AI systems and data center construction. Public statements from corporate leaders often suggest these figures represent maximum potential investment levels rather than guaranteed immediate spending. Many firms appear to be maintaining flexibility depending on economic conditions and the pace of AI adoption. Another challenge analysts are monitoring involves physical infrastructure requirements, particularly electricity supply. Large-scale data centers consume vast amounts of power, and expanding national energy grids or redirecting electricity infrastructure could significantly increase overall project costs. Energy availability has quietly become one of the most critical bottlenecks in AI expansion discussions. Globally, data center development is projected to require hundreds of billions of dollars over the coming decade. Some financial projections suggest AI-related companies could rely heavily on debt financing to support this growth. If borrowing accelerates across both private industry and government sectors simultaneously, financial markets could experience increased competition for available capital, potentially keeping lending costs elevated across multiple industries. Supporters of rapid AI investment argue that transformative technologies often require massive upfront capital before profitability becomes clear. Historical examples such as telecommunications networks, cloud computing platforms, and early internet infrastructure face similar periods of heavy spending before delivering long-term economic returns. Many believe artificial intelligence could follow a similar path, eventually generating productivity gains across healthcare, manufacturing, logistics, and scientific research. Critics, however, suggest aggressive infrastructure expansion carries risks if revenue growth fails to match expectations. Long-term leasing agreements for data center capacity have expanded significantly in recent years, creating substantial future financial commitments for technology companies. These agreements allow data center developers to secure financing by demonstrating projected stable income streams. However, if AI revenue growth slows or adoption takes longer than anticipated, companies could face increased financial pressure managing these contractual obligations. It's also important to recognize that many large technology companies maintain strong balance sheets and diversified revenue sources. These strengths may help offset potential risks. Still, some analysts believe monitoring leverage levels, capital spending timelines, and cash flow sustainability will be critical as the AI industry matures. Looking forward, several possible economic scenarios could shape how this situation develops. One possibility is that AI adoption accelerates rapidly across industries, allowing companies to generate sufficient revenue to support infrastructure investments. In this scenario, current spending levels could appear justified in hindsight. Another scenario involves borrowing costs remaining elevated while AI commercialization progresses more slowly. Under these conditions, companies might delay expansion projects, reduce investment commitments, or adjust growth strategies to preserve financial flexibility. Broader macroeconomic forces also play a significant role. The U.S. government continues managing large debt refinancing requirements over the coming years. Some economists suggest that government borrowing needs could influence bond markets and interest rate trends, which indirectly affect corporate financing costs. Changes in the composition of government debt buyers are also being closely monitored. Institutional investors such as pension funds and insurance companies remain major participants in Treasury markets. However, increased participation from private investors, hedge funds, and global asset managers introduces new dynamics, as these participants may react more quickly to economic changes and yield fluctuations. Another layer of complexity involves geopolitical competition surrounding supply chains, particularly for critical minerals and rare earth materials essential to advanced technology manufacturing. Government initiatives designed to strengthen domestic supply chains aim to reduce long-term strategic vulnerabilities. Supporters argue these investments could improve national resilience and industrial competitiveness. Critics counter that building domestic production and refining capabilities could require decades of investment and technical development. Existing global supply networks remain deeply interconnected, and replacing them entirely presents significant economic and logistical challenges. When stepping back and examining the broader picture, the global economy appears to be entering a period where multiple capital-intensive transitions are unfolding simultaneously. Artificial intelligence expansion, supply chain restructuring, energy transformation, and large-scale government debt refinancing are all happening at the same time. Individually, each transformation might be manageable. Combined, they raise complex questions about how capital flows, borrowing costs, and long-term economic growth will interact over the next decade. Some analysts believe interest rates may eventually decline as economic cycles evolve. Others argue structural factors, including sustained government spending and global investment competition, could keep rates elevated longer than previous financial cycles. At this stage, there remains considerable uncertainty surrounding how these forces will ultimately balance out. The long-term success of AI infrastructure expansion may depend not only on technological innovation, but also on financial discipline, energy availability, supply chain stability, and global economic coordination. The coming years may provide important answers about whether today's aggressive investments represent the early stages of a technological revolution or a period requiring careful financial adjustment. What do you think? Is the current wave of AI investment moving at the right pace, or should companies take a more measured approach while the technology continues to mature? Share your thoughts in the comments below. If you enjoy deep dives into global economics, technology shifts, and financial storytelling, consider liking the video and subscribing. It helps support the channel and allows for more in-depth analysis like this in the future. Stay curious, stay informed, and I'll see you in the next video.